and we're going over to our man, Mr. Chris Gaffney. Chris, folks, is the president of EverBank World Markets. And as you're over at our website at TFN, you can see the banner on the top of the side. You can hit that banner. We're going to bring you over to EverBank. Chris, welcome back to TFNN.
Thanks, Tom. It's always great to be here.
I'm telling you, man. And I just had Andy Hecht on, and we were talking about volatility, and it's amazing. It seems that every time that we do have you on, the volatility is there. It's pretty amazing. We had that jobs number. The market was closed. But certainly the metals, the currencies.
Well, and the currencies, yeah. The currencies were the big movers, of course. They got hit hard. Are turned around, actually. They've been hit since mid-March on expectations that the Fed wouldn't be raising rates in June as most had originally bet. So, that jobs number really hit the dollar, but we're coming back today. The dollar's up 1.25% today. So it was a big mover today.
Yeah, no doubt. No. Okay, so we had April 7th. We know that good old April 15th, tax day, we have to come up with the bucks so that our deficit can basically try to get paid off. And, as we come over to EverBank, can you talk a little bit about, because it's really unique what you have, meaning the aspect that you can take an IRA, whether you have one or open one, right? And you can basically, put precious metals inside that.
We can put precious metals in IRAs, and a lot of our clients are looking for safety, and they're looking. You mentioned the deficit here in the U.S., and we talk a lot about the debts that really the global debts that have been accumulated as these countries institute rounds and round after round of quantitative easing. So they keep printing money, they keep throwing liquidity at the markets. It's helped the stock markets, equity markets, of course, but in the background they're creating all of this debt. And so, eventually that debt, somebody's got to pay that down, and somebody's got to pay that off, and it creates some volatility that we've seen, and it also creates an environment where clients are searching for somewhere to park funds, and hard assets are in what are typically referred to as safe havens. Sure. And metals certainly is one of those. We can hold them in IRAs, we can hold them in non-IRAs, and it's a place that clients like to park funds, like I said, for safe haven purposes.
And folks, what's so cool about this, okay, so I happen to have one myself, okay, and what happens, just so if you think, these are so simple, it's amazing, because what ends up happening is that every year, you have to say how much is in it, but the bottom line is that a metal is a metal, okay? So when you're signing off, like, you have to sign something, say, okay, this is what it's worth, and you send it back, it's a no-brainer. I mean, because whatever gold is that day, guess what? That's what your account is worth. You know what's really cool, Chris, is that I was reading something today, in fact, because I put the gold report out on Tuesdays, okay? And what they were talking about is that we had the extraordinary run from 2001 going up to 2011, right? And we know how these gold companies are, unfortunately, is that they always spend too much money when gold's, like, high, right?
Well, yeah.
Yeah, so
they put a lot of, they're cutting back on the amount of gold they're mining, if that's where you're heading.
I am, and it's huge. Yep. I know.
Yeah, they're ending their capital. We had some huge losses of some of the big mining companies, of course, and they offset those losses by reducing their production. And of course, they're not going to produce as much when gold's down, and so they're going to cut back. We'll have a record production level, I think, of gold in 2015, but then it's going to start dropping. And what I read is, and maybe I read it on your piece, but that it's going to, really start cutting in 2017. So that's got to drive those prices higher eventually.
No doubt. And you have India and you have China that, you have more people in the middle class.
Demand's growing.
Yeah.
Demand's growing. So that's a positive on the supply-demand. Demand's growing. Supply is going down. That tells you something.
It does. You just brought up a great point, because about the aspect of it's not just the United States. When we look back 10 years, everyone thought that the United States was going to be the only one that was going to be in a deficit. And what's really happened, right, is that the whole world is basically printing now.
Right. QE in Europe. Europe started full-blown QE. They just finished their first month of full-blown QE. We've got Japan continuing to ease. We had the Bank of England, they've ended their QE program, but they're certainly not raising rates. They're, in fact, they may come back and cut them again. So we've got a lot of countries, and then China. The biggest one of them all, the elephant in the room, China is now creating more and more stimulus for their economy. And in fact, that's what kind of boosted commodity prices a bit today. We had a little bit of a goose from China saying they're going to try to stimulate their economy a little more.
It's amazing that all of us, I think, how much we can learn in the markets in general. And what blows my mind about China is this, Chris, right? And folks, this is like crazy how this works. China, like 1 second, says, oh, we're going to pull the plug, right? And then, like, what do they pull the plug, like, for 3 or 4 weeks? And then all of a sudden, like, the real estate will go down. So they say, oh, no, now we're going to flood the market again, right? I mean,
one of the advantages, and I'm not getting political here at all, but one of the advantages of controlling their economy is that they do have total control of their economy. They don't have to rely. They just don't have to go out there and say, we're going to cut rates and hope that the banks then start lending that money out. They control the banks, so they actually lend the money out. So I think they're able to get things turned much more quickly. Even with the size of their economy, they're able to get reactions in their economy much more quickly than some of the more established economies.
Yeah, no doubt. So when you're over at EverBank.com, folks, hit the investing button, because I want to talk with Chris about we're in a world market and foreign currency. You have foreign currency accounts. Let's talk about that a little.
You bet, and we do offer foreign currency accounts, but I'm going to share something with your listeners that isn't even out there yet.
Oh, cool.
And we're going to, they'll be first to hear about it. We're coming out with a new Market Safe CD, and these Market Safe CDs, it's going to be called the Future Economies CD, and it's a way for investors to take advantage of the emerging market currencies of Brazil, China, India, Indonesia, Mexico, and Turkey without having any principal risk. So it's a market-safe CD. It's not going to be live on our website till April 9th.
Okay.
So I'm 2 days before rolling this out, but I wanted to, if they check our website under the Investing tab or even go out to the website on April 9th, you should be able to see more information on it.
And folks, these are huge, okay? The way specifically, so let's talk a little bit about the aspect, and it's important to understand, folks, okay, with a Market Safe CD, you have no risk of losing your principal. So,
correct.
So can you talk a little bit about how the upside works versus just being flat?
Sure. In this Market Safe, we take the average of those 6 different currencies over a 5-year term. So it's a 5-year term, and we take the average return versus the U.S. dollar of those 6 currencies, and that's what the client will receive. Now, if the average of these 6 currencies drops versus the U.S. dollar, then the clients will just get their principal. So they cannot lose principal. If they put $1,500 is the minimum. If they put $1,500 into this CD, they will get $1,500 back at maturity after 5 years. Now, if the average of those 6 currencies move higher versus the dollar, that's the return they get. And this has a unique, what we call a jump note. So if it's above 0 but below 10%, we're going to give them 10%. So even if they only have a 3% average return versus the U.S. dollar over that 5 years, the clients are going to get 10%. So it's a jump note. It goes right from 0 to 10, and then anytime over 10, they'll get that additional return also.
Now, folks, so, we all know that the rates basically are low. Okay, so when you take a look at this aspect, Chris, this is really cool about what you have here with this CD, specifically because, let's say we just take rates, okay? Let's say it's a 1% or something, right?
Yep.
Well, when you take 1%, let's say you put $5 grand in, okay, over the course of 5 years, you get $250 back, right?
Right.
And what's so cool about this, so check this out, folks. Would you rather put a CD like Chris is talking about, and take the risk and say, okay, do I want to make 250? Because that's what you get probably
That's
anywhere
the
else.
opportunity cost. Yeah,
right?
That's the opportunity cost.
Or more money, and you're not going to lose any principal. This is a great time for those, man. You know,
it is, and it's so, you know, these fixed currencies are pretty volatile, and a lot of people say, well, you know, I would never, you know, want to go into Turkish lira or the Indonesian rupiah. I know there may be potential great upside, but there's also potential downside. So that's why we think this is a good vehicle to invest into those emerging markets, because of the volatility and because you're protected against
Absolutely. Thank you so much. Have a great one, Chris.